Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back to Power Breakfast on CNBC TV18. Let's take a quick check on the Asian markets. Remember, the US markets, they ended with a bit of a negative bias in Friday's trading session. And this morning, well, most Asian markets, they're trading with a bit of a negative bias. So the Nikkei, yes, it's down close to 0.5%, but it's recovered a tad bit from the low point of the day. While otherwise, in fact, the Kospi, that was trading with a bit of a negative bias with a cut of around 0.2%. Now that's moved into the green. The SGX Nifty, though, that's been in a world of its own. That's indicating a bit of a positive bias, maybe in fact a 15-point bump up is what we could brace ourselves for. But as I told you earlier, nearly around 25% of the Nifty either reacts to its numbers or in fact will be awaiting its numbers today. So let's start off with the big earnings today. Reliance Industries has delivered a steady set of numbers in the first quarter, strong growth in the petchem volumes, helping gloss over a slip in the GRMs. Sonia Shenoy has been doing the number crunching. She joins in early this morning to tell us the key takeaways. Hey Sonia, good morning.
Hi Nigel, good morning. Yes, the numbers were better than what the street was estimating on the operational front. And as you rightly pointed out, it was the petchem business that aided the numbers this time around. The petchem EBIT was at a record high this time. The margins for the petchem business have gone up 270 basis points on a quarter-on-quarter basis, coming in at 19.5%. And, you know, it was because of higher petchem volume. So it was a top-down, up move that we saw in the petchem business. Even if you look at the refining business, yes, there was a slowdown, but it was in line with expectations. So there was no negative surprise as far as the refining business was concerned. The refining EBIT was down about 5.2% on a sequential basis, coming in at 5,315 odd crores. The gross refining margins at $10.50 a barrel were bang in line with street estimates, so no negative surprises there. Apart from the petchem business, both RelGeo and Reliance Retail have delivered. So that's something that the street will definitely like. The RelGeo fall in the ARPUs were not as bad as what the street was estimating. Despite competition, they managed to restrict the fall in the ARPUs, and they saw an addition of 29 million subscribers in Q1 versus 27 million in Q4. So the subscriber addition has been picking up. Reliance Retail, although a smaller part of the business, has done very well this time around. It's a 7% sequential growth that we've seen in Reliance Retail revenues, and the EBIT was really strong, 12.5% up move on the EBIT for Reliance Retail. So on all fronts, really, the numbers are better than estimated, except the gross refining business, which was on expected lines. Back to you.
Okay, all right. So that's a consolidated view on Reliance by Sonia, but let's get down to more granular details about the numbers. We have Rima joining in to tell us how exactly RelGeo performed this time round. Rima.
Hi, Ekta. Good morning. Well, as Sonia pointed out, it was a very strong set of numbers from Reliance Jio, and the big beat came in from the fact that they managed to pretty much hold on to their average revenue per user, or ARPU, in a very competitive environment. So for Jio, this quarter, the ARPU declined by only 1.8% on a quarter-on-quarter basis, and compare that to a Bharti, which saw a 9.5% drop in their ARPUs. Also, if you look at the absolute number, it's much higher. So we always thought that Jio is the one which has initiated competition. They've cut pricing, but the ARPU at 134.5 rupees is actually higher than that of Bharti at 105 rupees. That said, the company has also seen very strong subscriber growth and solid data performance, which has aided their overall performance. On all metrics, the performance is actually superior than peers. So Jio's revenue growth was at 13.8% versus Bharti's. Wireless India revenue growth at 1.2%. In margins too, much higher than that of competition. So Jio's margins at 38.8% versus Bharti at 26.3%. So on the whole, strong numbers. Revenue growth for Jio. Now I'm just coming down to Jio's Q1 numbers. Revenue growth 13.8%, margins have improved by 100 basis points to 38.8%, and profit has gone up by nearly 20%. We spoke about ARPU and the and the fact that they managed to hold on to that, but even the other metrics like net subscriber addition has come in at $28.7 million, which means a run rate of more than 9 million on a monthly basis. Data consumed has gone up very smartly, so the total data consumed is at 6.42 billion GBs versus 5.06 billion GBs a quarter ago.
All right, Rima, but hang on. HCL Tech as well reported its numbers. Well, in terms of revenue growth, it was a bit of a miss, but the remainder of this year should be good, and also it has that valuation comfort, isn't it?
Yes, absolutely. So just to summarize it in one line, for HCL Technology, the revenue growth has missed estimates. Margins have come in line with expectation. The profits have come in higher than expectations, aided by a higher other income and lower taxes. So the constant currency revenue growth for HCL Technology was at 2.7%, which was aided by acquisitions. If you look at it on an organic basis, it is estimated at 0.7%, which is lower than what the street was anticipating. Margins have been maintained at about 19.7%. Profits have gone up by 8% on a quarter-on-quarter basis. Now, despite a soft start, that's because the Q1 revenues missed estimates, FY19 growth guidance has been maintained. So the company is holding on to its constant currency guidance of 9.5% to 11.5% for the full year, which means they're likely to do a 2.2 to 3.4% growth in the coming quarters. Also, they managed to hold on to their EBIT margin guidance of 19.5% to 20.5%. There are some positives in the numbers. For instance, the company has seen its highest ever deal wins. There is a big $500 million Nokia deal which will start contributing in Q3. Infrastructure management services, which was soft in Q1, had a growth of only 0.6%. A lot of deal wins came through in IMS, so that will also see a bit of a recovery going ahead. And as you pointed out, there is a valuation comfort. Compared to peers, it's trading at what, 13, 14 times forward multiple, whereas say a TCS is closer to 20 times and Infi is closer to 16, 17 times. So there is a valuation comfort. That said, the revenue growth was on this muted side.
Okay. All right, Reema, thanks very much for that. So, well, don't go away as yet because you have a busy day ahead of you. You have TechM, which you're looking at as well.
Yes. Now, if you look at the stock performance, this was one of the best performing IT stocks, say till April, when it had seen a 40% rally. Now, in the last 2 months, the stock has actually come off from the highs, nearly 15% from its peak levels, on expectations that Q1 will be weak. So we're not expecting too much. So dollar revenue growth could be down by 1.5–2%. The street is expecting a weak quarter. Revenues could see a decline in constant currency terms to the tune of about 0.7% on the back of a drag in telecom, which continues to look quite anemic. Margins will be under pressure, a compression of close to 150 basis points due to reversal of Comviva tailwinds, wage hikes, visa costs, and only partly offset because of the currency tailwind. That said, the management has guided for an improvement in margins Q2 onwards. Profits will be lower by nearly 3%. The key to track will be the outlook in the telecom vertical, which remains the key for further re-rating. Also, in terms of BFSI, because where it has been robust up until now, it came off a tad bit in the prior quarter. Also, their medium-term trajectory, because the EBIT margins have actually gone up in the last 4 quarters from levels of 8.2%, it's improved to 13.8%. So whether they can continue to improve their margins over a medium-term trajectory, because that said, at 13–14% margins, it's still lower than where peers are operating at. And whether in the enterprise segment, they continue to see above industry growth rates as guided by the management.
Well, we have a lot to watch out for from the financial space. We have ICICI Bank and Bank of Baroda, which will be reacting to their numbers today, which came out on Friday. Abhishek is here with us this morning to apprise us of what exactly the numbers delivered. So, Abhishek, start with ICICI Bank.
Well, good morning, Ekta. To begin with, ICICI reported a mixed set of earnings. While the overall slippages, came down to 4,000 crore versus 15,000 crore on a sequential basis, the non-watch list slippage remained elevated at 3,651, and that compares to about 3,634 crores, so which shows that major slippages are still coming in from the balance sheet. The net interest margin fell to 3.19%. That compares to 3.24%, and it is on the lower side in last 6 quarters, despite the fact that they have a 50% plus low-cost deposit share and their domestic loan growth has remained strong at 15%. The net interest margin decline is a worrisome factor. The stress assets overall increased to 25,000 crore versus 13,000 crore because they added about 12,000 crore from the SME portfolio. That's another negative worry. The valuations of ICICI banks are cheap. For the last 5 quarters, they have been showing a profit decline every quarter, and this quarter they have reported a loss versus our poll of profit of 1,400 crore. crores. So gross NPA in absolute value came down by 1%, while as a percentage of customer assets declined by 3 basis points to 8.81 versus 8.84. Overall, the gross slippages were at 4,036 crores, and that compares to about 15,700 crore in the previous quarter. Coming back to Bank of Baroda, Bank of Baroda reported a very strong set of numbers, given the fact that over the last 8 to 9 quarters, their domestic loan growth has been inching up, and that is now at 20% plus. The low-cost deposit share also is very healthy at 41%. Fresh slippages are getting arrested, and the credit cost, which is the provision for NPA divided by advances ratio, that is the lowest in last 10 to 12 quarters at 1.7%. So overall, when your slippages fell and your loan growth have remained healthy, the international NIM actually at 1.49% is the highest in last 8 to 10 quarters. That drove the overall NIMs on the higher side. You look at the overall NIMs now at 2.65%. That compares to 2.51 in the previous quarter. NCLT stress have also reduced as they got repayments. So the provision over there is now at 63% versus 55%. The absolute value of gross NPA declined by 1.1%, while the gross NPA ratio was at 12.5 versus 12.3. So expect a strong rebound in Bank of Baroda today.
Okay, all right, Abhishek. Thanks so much for that. Well, NTPC reported a rather steady set of numbers in its first quarter. Anisha joins us with all the highlights. Hey Anisha, good morning.
Good morning, Nigel. Well, yes, the positive was the top line because that jumped by around 14% for NTPC. And though the generation came bang in line with our expectations at 7.5% growth, it was the realizations that were better, and that is what drove the top line higher. But despite a higher top line, the company's profit came below estimates. That is because the other income of the company plummeted to around 136 crores versus over 660 crore reported last year. Yes, there was a bit of one-off element last year, but despite lower tax this year, the company's finance costs went up, and that's the reason the profit is lower. If you look at the internals as well, the EBITDA margin has been at around 26%. This is despite an employee cost rise of around 20%, and the fuel cost also went up for the company. But if you look at the internals and the operational details of the company, the under-recoveries regarding the coal business has actually come down. The under-recoveries are higher on account of maintenance, and the street expects that in the second half of the year, those will be recovered. Also, the company has approved raising 12,000 crores worth of funds. Now, one will question whether this is for the stake purchase of NHPC that the street is talking about. Also, lastly, the coal position of the company has recovered, so that should be a benefit for the second half of the year. Back to you.
Okay. Well, thanks, Anisha, for that. Let's get back to Abhishek now. Abhishek, tell us about what we can expect from HDFC today.
Well, Ekta, to begin with, I just want to highlight our viewers that IND-AS impact will be seen very closely on HDFC Limited, and that is on account of various reasons. The number one being that they have zero coupon bonds, so how that gets treated under IND-AS will be seen closely. They have huge ESOPs. The big impact will be now they'll have to make a provision with regards to fair price difference and debit it to P&L. So other point is mark to market. Now, no impact on group companies, but they have investment in various listed entities, so mark-to-market provisions need to be made. Commission paid to brokers on loans and deposits have to be paid at once as against the life of the asset, either on liability side or on asset side. So that will be seen very closely. Net interest margin above 3.75% will be positive. Last quarter it was at 4%. AUM growth above 18% will be positive. Last quarter it was at 18%. Asset quality has largely remained stable for this company. Anything below 1.2 in terms of gross NPA will be positive. Our poll suggests an NII growth of 16.5%, while net profit on account of low base last year will grow at 35% plus.
All right, what about Axis Bank? What do we expect there?
Another corporate number coming in, Nigel. So analysts on street or investors will be watching out for the slippage number. So slippages at and around 5,000 to 5,500 crore will be positive. Last quarter it was at 16,500 crore plus. Asset quality movement will be seen very closely, whether they get recovery of the assets that became NPA last quarter. The gross NPA was at 6.77% in Q4. The BB and lower rated book now forms about 2.8% of the book, and that is about 12,200 odd crores. How that moves will be seen very closely. NIM has been on a declining trend for the last 6 quarters, right from 3.8% to 3.3%. How that behaves will be seen very closely, and loan growth above 15% will be positive. Our poll suggests an NII growth of close to 6%, while net profit of 530 crore, which will be down 59% on a YOY basis. Back to you.
With earnings then and results expected today, IndiGlobe comes out with a set of numbers. Sonia's with us to run us through what are the expectations there. Sonia.
Well, thanks for that. You know, the stock has been under a lot of pressure lately. In fact, it's at a 52-week low. It's down 16% in 2018. The reasons are because there's been a lot of pressure in the fundamentals as well. It's a double whammy of sorts for Interglobe because on one hand, ATF prices have been rising. On the other hand, yields have been hit quite a bit. Remember, last quarter, the yields for Interglobe Aviation fell by almost 6.5%. And the expectation is that that pressure could continue this quarter as well. Now, I have some estimates from Kotak, where Kotak says the revenues could grow by 14% on a year-on-year basis. That's because the passenger growth was very strong, up 22% in the first half of calendar year and 20% in Q1, in line with the industry. The problem really is in the operational performance. So they're expecting an EBITDA fall of almost 75% and the margins to fall to 4.5% for the company. That's because the yields will continue to decline. So the yields are expected to fall 6.5% on a year-on-year basis in Q1. Remember, there was a 5.6% year-on-year fall that we saw last quarter. So yields are expected to come at 3.1 rupees per kilometer. Not just that, ATF prices have gone up 28% year-on-year. So all of that is going to put pressure on Interglobe's operational performance. But some of that is already in the price. As I said, the stock is at a 52-week low.
Okay. All right, Sonia. Thanks very much for that. Well, let's move across to commodity and currencies now. Manisha Gupta joins in this morning to tell us what she's tracking. Manisha, morning.
Hi, thank you so much for that. Well, starting with the crude oil prices, where we have seen a divergence between the two varieties. While you have seen some pressure continue for Brent, it is the U.S. crude oil prices which have continued to gain after 4 weeks of decline, that is. If you look at the U.S. crude output, that is at record highs, so are the exports. And even as you have seen a 3-rig count up in the overall drilling sector, the bullish bets also are down for a second straight week. One thing that is working in favor of the crude oil price is the second quarter GDP numbers from U.S., which grew at the fastest pace in 4 years, and that really seems to be supportive for many of these commodities today. The U.S. dollar has strengthened as well, and that in turn is putting pressure on the metal space. So you have the day starting with gold prices slightly on the weaker side, and that's exactly the case with the other base metal prices also, which have started, 0.25% to 0.5% on the weaker side for most of them.
Okay, all right. Thanks so much for that, Manisha. Well, let's hop across to Mangalam. I was telling you, the FIs, yes, they're bullish in the cash market and even in the derivatives market. They looked very, very bullish. Mangalam, run us through all those details.
That's right, Nigel. All-round positive cues coming at record highs from all the spheres in terms of fund flows. We start with the cash flows. First day of the series, both the FIIs and the domestic institutional investors pumped in together around 1,150 odd crores in the cash market. That was backed by some purchase in the future space also by the foreign institutional investors. First day of the series, remember the FIIs entered the series with 58% long exposure. They added a little more, close to 700 crores bought in index futures, close to around 18,000 long contracts, 9,000 short contracts added. In a sense, 2 long contracts for 1 short contract added on index futures. That means the long exposure, which was already at 58%, now has increased a bit to 59%. A net sell figure of 200 crores in index options, and that is a positive because what did they sell? They sold index puts. So if you take a look at their action in long index calls as well as short index puts, they've added 1 long call and written 1 put. That means they're hoping for an upside while they believe the downside is protected. So that is something we'll be watching out for. 11,200 put. That was the most active on Friday's trading session. 10 lakh shares added out there for a premium of close to around 110 rupees. That's telling you maybe 11,100 is a mark that we have to watch out for in terms of support. 11,100 put as well as 11,000 put 2 saw some selling, so that indicates some support at the lower levels. At the higher level though, 10,400 call, that one saw a bit of an open interest spike for a premium of 100 rupees. That's telling you that 11,500 is a mark that perhaps the street will be watching out for on the upside. If we were to cross that, then 11,700, there was a bit of a punt buying out there. In terms of stocks, watch out for Adani Enterprises out of F&O ban after getting into F&O ban on day 1 of the series. And finally, watch out for Chola Financial because that stock reported a good set of numbers on Thursday's trading session, fell in Friday with a lot of open interest spikes. So that is something I'll be watching out for.